All right, so today is Wednesday, July 24th. Recording is on. Welcome to essentially week 3. So as we get started today, any general questions or anything anybody wanted to talk about? All right, well, if no big issues, basically want to talk about the 2 homework assignments you had for this week, go through that and get you set up for next week's homework assignment on valuation, which, as a heads up, I just changed 10 minutes ago. So given the real-time nature of the class, I don't want you doing something from Nokia from like 3 years ago. So we are going to actually do a evaluation of NVIDIA based on data from yesterday. So I thought that would be more interesting and relevant to what's going on today. So anyways, we'll get back to that when we talk about your assignment. So back to our homework assignments for today. We had 2, and one of the assignments was the economic statement conversion. And in the, I'm trying to figure out where I put it, the file section, let's make sure I see it. All right, I just published in the file section a folder. Share this on my Zoom. We're here called week 3 solution. And in this folder, there is the conversion solution file, which is the solution to the economic statement conversion you just did. So I'm going to reshare this file in Excel. So stop the share in Excel. And reshare the screen. All right, so this part of the exercise was hopefully pretty straightforward. You took income statements and balance sheets, and you created the 4 economic statements that balance, right? So in terms of, I'll put up the TFI, but I'll start with the TFI. Was this fairly straightforward? Does anybody have challenges converting the TFI? Kind of questions about the TFI? Did you get these numbers? Did you get to balance? Do you have any issues getting it to balance? Young?
Yeah, everything seemed like it matches except for the CFI. Hold on.
Yeah, we'll talk about TFI first, but before we go there, TFI. Anybody have issues with
TFI.
TFI? All right, because if everybody got it, you kind of understood it, don't want to spend a lot of time on it. But if we need to talk about it, let me know. All right. So this is just the rearranged statement in Bedigliani Miller, and it needs to balance, and hopefully you were able to do so. Second statement you needed to convert was the TII, which is the rearranged income statement. Again, this would be the solution. Did anybody have challenges with the TII that you want to talk about? Or did we all kind of get it to balance and hopefully everything put in the right bucket and in the Modigliani-Miller format? So we have our operating, which is our NOPAT, non-operating, operating plus non-operating TII, debt, equity. That's Modigliani-Miller here. 1, 2, 3, 4s. Any issues with the TII? All right. So I'm guessing some of you were challenged by the CFI. So back to Yang. Go ahead.
Yeah, it's weird because I got the second part right for 2019, negative 227. But for 2018, I ended up getting a, mismatch. And I just could not figure out where I went wrong. For the top portion, I got 338.4. On the bottom portion, I got negative 118. So I don't know how that works out.
Well, as I said, what you say is actually typical as we're kind of learning this new language. The cash flow statement is the most challenging because it's not GAAP cash flow. All right, this is kind of Modigliani-Miller cash flow. But the first part is for operating. Did you get the free cash flow 654 and the negative 475? Like right here. Did you get that? And I'm asking Yang as well. It looks like he might have just frozen. All right, well, back to everybody else. Did everybody else get the free cash flow? Any questions about free cash flow? All right, because that's actually a very important part of the statement, the operating free cash flow. All right, because that's telling you the profit after reinvestment that a company will generate. All right, and so again, if you're generating free cash flow, that's your theoretical payout rate, and that's going to eventually be the operating value of a business. So positive free cash flow is really, really important over time. If you have negative free cash flow, that means you're investing more than you're making, which means you're going to have to go borrow the money. You're going to need to go fund the negative free cash flow. In 2018, this made-up company had positive free cash flow 654. In 2019, it had negative free cash flow 475. Okay, and that's the cash from the operations. Profit after reinvestment. Right. And then the difference between the free cash flow and the CFI are the non-operating items. Okay. And so again, if you go back to the video, the concept is when you calculate cash flow, it's the cash from the income statement minus the reinvestment in the balance sheet. So income statement minus change in balance sheet, right? Which means you look at all of the twos, if you do the non-operating items from the income statement, okay? And so the income statement cash flows from non-operating were the after-tax interest income and the after-tax non-operating income. Okay. And again, we want to tax affect it because we're spreading out the tax impacts into each of the areas. And then the change in the balance sheet is the change in the non-operating items in the balance sheet. Well, there were three twos. Change in excess cash, change in the equity investments, change in the other long-term non-operating liabilities. So those were the 5 things that you needed to account for, right? And so the 2 keys are make sure you do it after tax, right? And the other piece is to make sure you kind of get the signs right, because the idea is it goes back to CFI. If I'm making money, I'm generating cash that I can pay out. So it's positive to the CFI, right? So if I make interest income, it's positive to the CFI. It's $21 million of cash that I can pay out. If I generate non-operating income, $8 million, that's positive to the CFI, right? So it's a positive number. If I stow cash away in a savings account, well, that's money I can't give to my investors. That's negative to CFI. If I buy a stake for $345 million in another company, that's negative to the CFI. It's going to detract from the cash that I can pay out. All right. If I pay off my non-operating liabilities, I've used cash. It reduces my CFI, reduces the cash that I can pay out. And so that's what I was kind of hinting at the video. Like part of this is just thinking through what's happening to the cash, and that kind of answers the questions for the signs. But the key is CFI is just that. It's the cash that I'm generating that I can give to investors from operating and non-operating activities. So any cash coming in that adds to that, positive. Any cash going out that takes away from that, negative. And that's kind of how the statement is formatted. Questions about that non-operating items? Yeah. Is it Dewey?
Dewey.
Dewey.
For the non-operating section, do you want us to list out every change like that? Or is it okay if we have it all summed up as non-operating invested capital?
You could have netted it and that would have been fine.
Okay,
As long as you kind of get to the CFI and you kind of understand when you netted what you were netting.
okay. Thank you.
Did you get to these numbers?
Yeah, I did.
Okay. Everybody else kind of at least understand the 213.4 and the negative 227? Is Young back on the call? You got frozen if you just dropped off and was back. All right. And then the other side, as I said, has to balance. So that's the thing. If I have 213 million to pay out, then the other side of the statement called the financing or funds flow, what did I do with the 213 million? How did I give it to my debt and equity holders? If I'm short 227 million in cash, the other side of the statement said, where did the 227 million come from? All right. And those have to balance, which means a negative CFI on the operating side has to be a negative CFI on the financing side. A positive CFI on the operating side is a positive payout on the financing side. So the tricky part, as you're learning this, is that on the financing, the debt and equity side, any payout is going to be a positive number because I have cash generated. It's going to equal the payout. Any loss that I have is going to have to be borrowed. So any negative number on the operating side is going to be a negative number, an inflow on the financing side to pay for that. All right. So that's the only other kind of curveball or trick when you're learning these statements. So any questions about the financing side of the CFI here with these two companies? About how we got the 213.4 or how we got the negative 227. Jim?
Can you explain the signs on the non-operating changes, like the excess cash?
So if you're looking at up here,
Yeah.
so again, conceptually, positive CFI, I have cash to give to these people, right? So the idea is anything that is adding to the cash flow available to investors is a positive number in the non-operating or the operating section. So when I make interest income, that is adding to the cash available to pay out to the investors. Therefore, it's a positive number. When I generate non-operating income, that's a positive number because that's adding to the cash that I can pay out to my investors. All right. Now, when we get to these balance sheet items, change in excess cash. All right. The metaphor that I used in the video, and it just helps me understand it, is the idea of a checking account and a savings account. All right. So basically, you pay your bills out of your checking account. You don't pay your bills out of your savings account. So anytime you take cash out of your checking and you put it into savings, you're reducing the money in your checking that you can use to pay your bills. Okay, so that's kind of metaphorically what's happening here. When a company increases its excess cash balance, which is kind of like a savings account, then it's decreasing its CFI, right? Because it basically says, I'm not going to use the cash to pay it out as a dividend or pay back a bondholder. What I'm going to do is I'm going to put in the bank. Okay, so it reduces my CFI. That's the negative 105. So when my excess cash increases, then my CFI decreases. The opposite is true, right? If I raid my savings account because I don't have enough money to pay my bills, that reduction in excess cash increases my CFI because I now have more cash to give to the debt and the equity holders. So a decrease in excess cash is a positive to CFI. Okay. Same thing, equity investment. If Microsoft buys a stake in OpenAI, okay, that reduces its cash balance. I can't pay out cash because I put all that money to buy the stake in OpenAI. That's a change in equity investment that hurts the CFI. So when you have a negative change in equity investment, what that means is you basically are reducing the CFI because you increased your equity investment. When you sell off a stake that you have in a company, well, you're generating cash. That will add to the CFI, right? And then the other long-term liabilities, as I said, when I owe money to you and I pay you, well, that reduces the cash I have to pay anybody else, reduces the CFI. When I owe money to you and I don't pay you, well, that allows me to add cash because I can use that cash to pay somebody else. So an increase in liability actually increases my ability to pay other people since I didn't pay you. So it's almost like you got to think through what's happening with each of these accounts, and that will help think through what the sign should be, whether it's adding to your cash to pay out or whether it's taking it away. Does that help at all? Does that make sense?
It does.
Sense?
Yeah.
Okay. So that's why those three are negative. All three in column C are negative because I increased my excess cash. I bought in my equity investments went up. I bought a stake in somebody else, and I basically paid down some bills. So that's why the change in non-operating liabilities is negative. All three of those reduce the cash available. That's how 654 turns into 213. Other questions? No questions, a dumb question. Now's the time to ask. All right. And then the fourth statement, economic profit, also known as economic value added, but we can't call it economic value added because Stern Stewart has trademarked the term. So the rest of the world calls it generically economic profit. But this is kind of like a one period NPV, right? Two methods. Method number one is called the spread method. What's your ROIC? What's your WACC, right? When your ROIC is below your WACC, you have a negative spread, right? When you have a negative spread, you're destroying value. So it's a question of how much value did you destroy with a negative spread? And so the idea is you take your negative spread, C8, and you multiply it by the capital. So if I have $3.2 billion worth of capital and have a negative 1% spread, then that's the equivalent of destroying $34.6 million during the period. Okay. Or another way of saying the same thing, if I make $161 million worth of profit and I got to earn a 6% WACC on 3.26 billion, 6% on 3.26 billion says to pay back investors, I need to make at 6%, I need to make 195.6 million. I made 161 million after tax. I'm short 34.6, the amount I need to pay my investors 6%. I have destroyed that much value. That's the concept of economic profit, or EVA. And so it's just saying, am I earning my cost of capital, right? And it's just putting it in dollars, right? Percentages, kind of like IRR, dollars, EP, kind of like NPV, right? So spread is IRR versus R, dollars NPV. So in this case, destroyed $35 million worth of value, destroyed $33 million worth of value. Even though I made a profit, I didn't make enough of a profit to cover my cost of capital. And that's how much profit in dollars I would have needed to make 6%. I'm guessing most people at least got this structurally. Again, questions about any of this? All right. Well, the other assignment had to do with once you've converted this data then how do we analyze it? And that's what we call the historical analysis, right? And for you, I gave you data for Nike on their ROIC tree and their CFI. Okay, and you had to analyze both of those. So let's start out with the Nike ROIC tree for the days I did. This. Share screen. All right. So the key here, when you analyze this CFI for any company, zoom a little bit more, is we are trying to explain the end of year ROIC change for a company over a 5-year period of time. Okay. And so this for Nike was a period from 2016 to 2020. And so the idea is what caused the ROIC, EOI's end of year, it's based on December data, essentially. But what caused the end of year ROIC, end of year profit divided by end of year invested capital to basically go up or down? All right, for any company, there are 3 reasons this changes. Always 3 reasons. That's the first level of analysis. So you're trying to explain that change by those 3 reasons. Reason number 1 is the cash tax rate. Okay. So basically, in 2016, Nike's tax rate was around 19%, 18.7. In 2020, Nike's tax rate was 12.1. Did that help or hurt the CFI of Nike? Or sorry, the ROIC of Nike?
It helped.
Nike's paying less in taxes. Does that help the ROIC or does it hurt the ROIC?
It helped.
It helped the ROIC. So the whole point is, because the tax rate went down from 18.7 to 12.1, Nike's ROIC should be going up. Well, it didn't. It went down from 41 to 20.5. So Nike's pre-tax ROIC, essentially the business of selling shoes and apparel, got worse. They went from a 51% ROIC in 2016 pre-tax to a 23% in pre-tax ROIC in 2020. All the decline was the operations. Taxes should have helped them. What drives pre-tax ROIC? Driver number 2, margin. How much does Nike make when they sell their products? In 2016, they made 13.9%, 13.9 cents per dollar. In 2020, they made 8.3%. Is that better or worse?
Worse.
What does the impact on ROIC?
That's going to decrease their ROIC.
That's what you needed to say. Okay, so that drop from about 14 cents per dollar of operating margin to 8 cents would have decreased the ROIC. And that's one of the big reasons why the pre-tax ROIC went down. They're making less money every time somebody buys their product. Patrick?
Yeah, just in general for the homeworks, are you looking for us to say literally that one sentence, or do you want us to say because it changed from 13.9 to 8.3, that's a 5%, whatever, are you wanting us to like write several sentences and describe it, or just say it is decreasing ROIC?
So I want you to do something because I think this will help everybody. Okay, just bear with me for a second. Everybody in this call, close your eyes for the next 30 seconds and just listen to what I say. But please close your eyes. Okay? Everybody got their eyes closed? All right. In looking at this ROIC tree, you can see it's getting worse. If you look at the operating margin, you notice it's going down. And the invested capital sales is going up. Okay. Now, if you look over here in working capital, like the working capital seems to be going down a little, but the PP&E is getting better. Actually, no, it's getting a little higher. You can open your eyes now. Does anybody know what the hell I just said? Did you follow along? Was that meaningful? And I'm just telling you, real world, not just in this class. When you start making general comments about a data intense slide, nobody knows what the hell you're talking about. Okay, because you know what you're looking at, but everybody else doesn't know what you're looking at. And they can't connect the dots that you're connecting in your mind. And so that's why I'm kind of harsh in this class about using numbers. And I do the same thing in the real world, right? Because if you go into somebody, you say, the operating margin went from 14% to 8%, and that's why it's getting worse. Well, people can understand that. And they know exactly what you're talking about because they see the data you're calling out on the screen. So that's the numbers in this class that are important because it helps show me that you're connecting dots and that you're actually knowing what you're talking about. And by the way, when you do this in your jobs, it makes you more credible, much more credible than a lot of presenters, especially when you're doing a finance presentation. So the short version or the long answer to the short question is yes. I want you to use numbers and I want you to connect dots, and that's universal. Jen?
Do you care about how the curve is described in the in-between points? For example, for operating margin, do you care about the 2020 being diffed with 2016, or do you care that it looks like a downward sloping step function where 2016 and 2017 is flat, 2018, 2019 is flat, and then there's a precipitous drop off at in 2020.
So for this assignment, where I'll just say the training wheels are on, like if you minimum talked about beginning and end, that's okay. But you're going to have a group project, which is 40% of your grade. And when you do it for your group project, I'm going to care that you talk about the intermediate years. And I'm going to care that you relate it back to real world. Like if you notice that the operating margin dropped precipitously really in 2019 to 2020 from 12.2 to 8.3, that was the biggest year of the drop. Like what happened in 2019 or 2020? Like if you were on the other side of the table as an analyst, you'd be wondering the same thing too. And that if you're in the conference call with the company, you'd be like, all right, what was behind the drop? You know, or you see a big jump in goodwill. You're like, okay, there was an acquisition. Who'd you buy? Like, there's an answer to that. We should have some context, right? So yes, that's what I want you to eventually get to. But if you didn't do that in this assignment, I'm not going to overly penalize you. But as we get to your group project where you have 5 or 6 people working on this for a few weeks, then I'd expect a little bit more granularity and detail. But that's ideally where you want to get to. All right. Productivity, invested capital sales, 2016, 27%, 2020, 35.8%. Is that better or worse from an ROIC perspective?
Worse.
Yeah, they're now spending more to generate the same sales. So if you look at Nike, they got 2 things that are hurting them. They're spending more to generate the same sales. They were spending 27 cents. Now they're spending 36 cents. So they're spending about 9 cents more per dollar to sell something. And every time they sell it, 14 minus 8, they're making about 6 cents less on every product that they sell. So if I'm spending more to make less, my ROIC is going down. And that was the challenge that Nike was having during this 5-year period. 3 drivers, always talking about the 3 drivers. The third one is they were offsetting this somewhat because they paid less in taxes, but I think investors were more concerned about the pre-tax performance. That's your first level analysis. Then you got to do a second level analysis. Why did the operating margin go down? The numbers on the right come from the income statement. Operating margin, also known as EBIT margin, is your gross margin minus your SG&A minus your depreciation. So these 3 things on the right explain the operating, also known as EBIT margin. In fact, gross margin minus SG&A, that's EBITDA margin, minus depreciation, EBIT margin. So this minus this equals that, right? So why'd they go from 13.9 to 8.3? Starting with the gross margin. This is price minus cost. They had a 48% gross margin in 2016, 45% in 2020. That 3-cent drop in gross margin, is that beneficial or hurting their operating margin?
Hurting.
Gross margin down, it hurts your it hurts your operating margin. So this hurt them. They lost 3 cents of operating margin here. They spent 32 cents per dollar in SG&A in 2016. They spent 35 cents per dollar in 2020. Is that better or worse?
Worse.
Worse.
Worse. I'm spending 3 cents more in operating costs to make 3 cents less every time I sell a pair of shoes. Depreciation, 2 cents to 1.9, virtually unchanged. Okay, so the story of the operating margin is the decline in the gross margin and the increase in operating expenses. And by the way, a lot of the increase happened between 2019 and 2020 in SG&A. Invested capital sales, that's your balance sheet. 3 things on the balance sheet add to operating invested capital. OpWC is working capital, operating working capital. PP&E is property, plant, and equipment. Intangibles is goodwill and intangible acquisitions, premiums. You add those 3 things up, you get invested capital sales. So when they had 15 cents of working capital in 2016, and they got it down to 13 cents in 2020, was that favorable or unfavorable financially? To ROIC?
Favorable.
That's favorable. Yeah, they got more efficient with their inventory receivables. Great. PP&E, that's the building, land, and equipment. They went from 10.9 cents per dollar on PP&E to 21 cents per dollar in 2020. Favorable, unfavorable?
Unfavorable.
They're spending twice as much, essentially, in their stores and their IT to sell the same products. They went from 1.3 cents to intangibles to 1.3 cents, virtually unchanged. So no big acquisitions. So why did Nike's productivity get worse? What was the primary driver?
PP&E.
That's what you need to say. That's what I'm really looking for at a minimum in this assignment. Questions? Stephen?
Yeah, quick question about this. Could you make the case that with all that being true, that it is trending negative, that Nike actually did really well in 2016, 17, and 19, but they just had 2 bad years in 2018 and 2020. 2018, I think, was because of Tax Act. Obviously, their taxes went like through the roof, and then 2020 was the pandemic. So it almost seemed like those could be explained as to why, or those could be explanations as to why Nike performed poorly, but it's not an indicator that they're going to trend down in 2021.
Well, you brought up several good points, but the most important one is what I'll just say generically. Financial statement analysis, which this is a form, does not give you answers. It actually leads to more questions, right? Which is what you're bringing up. Like, why is it going down? We know it's going down, but what's causing that? Like, you're going to want to go find out more about that. And you related it to a potential couple things, but that's the thing. We'd want to kind of validate that and understand. And then, is this one time or is this recurring? That's going to be an important part of the question. And are they spending now to basically help themselves later? So we do want to have a little bit of a future view. Now, we don't have that when we look at the historical trees, but that is good context. And you're not going to have all of that, but at least you kind of know what's going on structurally, and it leads to some additional areas that you might want to go investigate. And that's kind of our perspective of why we do this. So I think you brought up some really good points there. That's our ROIC tree analysis. Second statement you had for Nike was the CFI. And they're somewhat related because ROIC is the shortcut to CFI, right? Or sorry, it's the shortcut to free cash flow. Okay, it's ROIC is the proxy, right? Free cash flow is hard, ROIC is easier. It's basically the same thing at the same level of growth. If you make a 10-cent ROIC, you're generating 10 cents of cash per dollar of investment. If you have a 20% ROIC, you're generating 20 cents per cash per dollar of investment. And 20 cents is worth more than 10, right? And so that's the whole idea. that free cash flow is the actual kind of like NPV, and ROIC is kind of like IRR. All right, they're eventually going to be equal, and they're going to give you the same answer. Right, it's just ROIC is a little easier because it's a percentage, but it gives you an understanding of free cash flow. So when we do the CFI analysis, which has the free cash flow on it, it is going to be influenced by what you see on the ROIC. So if your ROIC keeps going down, then my guess is your free cash flow is not going to be doing as well. If your ROIC is going up, your free cash flow is going to probably go up. So these are related statements, okay? But nonetheless, the other homework assignment you had to do was the Nike CFIs. Go back to this. For that same period. Let me share that PDF. Zoom. Sorry, way too many windows open here. So when you do a CFI analysis, you always start with free cash flow, which means you always start right here. Same idea. I'm summing up the 5 years. We can start with the totals, but eventually you got to talk about the intervening years as well. Okay, so we start with free cash flow. Nike generated over 5 years, these 5 years, $10.671 billion of free cash flow. They made more cash than they spent. Okay, now that's going to be telling to our analysis, because the eventual part of the analysis will be where the 11 billion of free cash flow go, right? But they generated more than they spent. So let's talk about why. From the income statement, their gross cash flow, they made 20 billion of gross cash flow from the income statement. They reinvested $9.3 billion of investment back in the balance sheet, working capital and CapEx. That gave them about a 10.7 billion of free cash flow before acquisitions, and that represented a 46% reinvestment rate. Okay, so Nike on average over 5 years reinvested 46% of the cash they made back into their business, which theoretically means a 54% payout rate, theoretically. Okay, and for Nike is pretty close because they didn't spend hardly anything on acquisitions during this period, 85 million of goodwill. So free cash flow before goodwill is pretty close to free cash flow after goodwill. Now, there was one item that wasn't on this statement that I start doing in later classes. So I think it's useful to think about, right? It's not just the investment rate, but there's a ratio of CapEx to depreciation, which is very important, okay? So here's depreciation. You see that? And the point of depreciation is, from an accounting standpoint, that's the amount of the assets that are wearing out per year. Now, most of the time we do it straight line. And there's an assumption we make. It's not always perfect, but it's what we do. The assumption is you have to reinvest depreciation to maintain what you have at kind of its current situation. Okay. So if you're going to tread water as a business, you got to put back depreciation. If you spend more than depreciation, then that's a growth signal, because what you're saying is I'm expanding. I'm spending more than is was wearing out. If I don't spend my depreciation, then things will actually wear out faster than I'm replacing it. And that's a good perspective. So one of the other ratios we'll look at is the ratio of CapEx to depreciation. Okay. So over 5 years, Nike spent 8.5 billion on CapEx. Over 5 years, they spent about 3 billion on depreciation. What does that tell you?
But they spent way too much money towards 2020. I see a increase of 546%.
Well, I'm just saying, over 5 years, we'll come to your point next. Over 5 years, if you're spending more than 8.5 billion on CapEx and you're spending 3.5 billion in depreciation, what is that telling you? So I see some hands up. So let's go with Mike Mitchell.
Yeah, I was just gonna say that's a strong growth signal.
Yeah, Nike's clearly signaling they're trying to grow. Now let's go back to the last point about 2020. What are they telling you about 2021? Now, I'm not showing you 2021, but what are they kind of signaling about 2021 if you look at that ratio? Yeah, is it Zillan? Do I have that right?
Yep, shitting. I think we were expecting a strong growth for next year because of
Yeah.
investment.
They're spending 5 times their depreciation, which suggests that they expect some growth. So that's another thing that, you know, even in financial statements, you can see some signaling by companies, right? Because they don't usually go buy a bunch of stuff if it's just going to sit around and be idle. So if you're spending a lot of CapEx compared to depreciation, that's telling you that the company is actually buying that CapEx because they think that they're going to grow. Okay. And the opposite is true. If a company suddenly doesn't spend anything, then they're probably signaling, I don't expect some growth in the near term. So it's also a good kind of near-term signal for a company. All right. Now let's go back to free cash flow. They got 10.7 billion of free cash flow. What did it do to CFI? They had about 9.8 billion of CFI, which means they chewed up some cash in non-operating items. So what happened? Well, the first thing they did is they took 2.7 billion of their cash and they banked it in excess cash. So they basically put 2.7 billion into savings. Now they actually sold some non-operating assets and made a profit of about $1.5 billion, but net, they had about 1.1 billion, just called about $1 billion of non-operating cash that reduced their CFI from free cash flow of 10.7 to about 9.8 billion to pay out. And then how did they pay it out? They paid 398 million to the bondholders for interest. They borrowed $11.8 billion worth of new debt. Now, do you think, based on this data, Nike needed to borrow $11 billion worth of new debt? Greg?
No, they did not.
Yeah, because if you're generating 10 billion of free cash flow, why do you need to borrow $11 billion worth of debt? Okay. So what are they going to do with all this money? Well, let's look. They paid $6 billion in dividends and $18 billion to the shareholders. Well, that's $24 billion of cash that they gave to the shareholders. How do you give $24 billion to shareholders if you only got $10 billion to pay out? What's going on? Yeah, Steven?
It's because they took out debt, but are you asking why?
Yeah.
Or
No, well, that's the point. Like, why would a company do this? But before we even get this, we know that that's what they're doing.
there's
They're literally borrowing money to pay back the shareholders.
two reasons I can think of is one, there were lower interest rates, so it was a good time to take out debt, and the other would be to improve their EPS because a better EPS is tied to like company management compensation.
What was happening to their operating profits over the last 5 years? Think back to the ROIC rate. What was happening? What happened to their operating margin?
It was going down,
Which means they're making less money.
right?
All right. Now, from a share price standpoint, for ROIC is going down because your margin's going down and you're not getting good returns on the investments you're making, your share price is not doing really great. So your share price is now what they would call cheap. So I'm investing in the company. I'm going to prop up the share price and buy back a bunch of stock that also, by the way, manufactures earnings growth because same earnings with fewer shares equals EPS growth. And so in a way, yes, they took advantage of cheap debt. Yes, they changed their capital structure. But I think in a way, they were kind of trying to prop up their stock because the underlying operations were getting worse. They didn't prop up their stock because they were generating all this cash and paying it all out. Like if they had paid out their free cash flow, it's one thing, but they paid out a whole lot more than their free cash flow, which means the money that they paid out came from the banks, didn't come from the customers. And yes, I like cash, but that's not as attractive and not sustainable. And you see that in their CFI. Questions, comments about any of that? Does that make sense? Greg?
So if a board of directors sees that you're doing that, right, and you're like the management company, management
The
team
board had
doing
to
it,
approve it, so they know you're doing this, but go ahead.
so if they know it's unsustainable, like what, like are they just short terming it and just hoping for the best, or like it sounds like
Yes. But I'm just saying, like, why would a company do this? There's lots of reasons. You're like, hey, I'm rewarding you. Hey, I'm, basically giving you money now based on things I'm gonna do in the future. But what I'm telling you is a sophisticated analyst is gonna see right through that and they're like, it came from the banks. So yes, I'll take the cash, but I know that you can't keep repeating this because at some point the banks are not gonna keep lending you that money. If you can keep paying it out based on your free cash flow, then that is sustainable. All right? So, and let me be more specific. So that was your assignment for last week. So today I am here in Hartford, Connecticut, working with a company called RTX, formerly known as Raytheon. It's a merger of Raytheon and United Technologies, call themselves RTX now. They're a $60 billion behemoth that has three businesses. Half their business is defense, half their business is commercial airlines. Two biggest customers, Boeing and Airbus. They make parts for the 737 MAX. They make Pratt & Whitney jet engines. Okay, so long story short, here is their ROIC tree. Which I think we looked at briefly last week. Public data, not sharing anything that you couldn't get right out the website and do yourself. So here's the point. What's going on with RTX? Look at this ROIC. Their WACC has been averaging about 7% a year. Is that a good ROIC over this 5-year period through 2023?
Not at all. Looks terrible.
Okay. And oh, by the way, why is this ROIC getting worse? 5 to 3? Because their operating margin went from 11 to 5. They actually got more efficient on their balance sheet, $1.91 to $1.52, but they've had a drop in their operating margin. Why? Because their gross margin went from 29 to 24, 30 to 24 actually. So they had a 6-point decline in gross margin, which is basically the 5-point decline, primary driver of the operating margin. Okay. So what's going on in their business? Why are they spending more relative to their price, which is really hurting their operating margin, hurting their ROIC? That's one conversation. Okay. Then we do a CFI analysis. I'll just focus on free cash flow. So here is a shortened version of what you just did. Okay. So what happened over 5 years? They generated $34 billion worth of cash from their income statement, which peaked, by the way, at 8.9 billion in 22, fell to about 7 billion in 23. Okay. They reinvested 29 billion. They reinvested 5 billion gross investment, because even though they put in $10 billion of CapEx, they freed up 5.4 billion of working capital. So they net reinvested 5 billion, which is 5 billion from 33, gave them about 29 billion of free cash flow before acquisitions. They spent $1.5 billion in acquisitions, which gave them 27 billion of free cash flow to pay out. If you actually looked at the other side, I just simplified the statement for a bunch of executives. They paid out 10.5 billion of dividends over the 5 years. They bought back $14.5 billion worth of stock. They basically paid investors $25 billion. Could they afford that? How much free cash flow did they generate?
yeah,
27 billion.
yes, they could have.
27 billion, and they actually paid out 25. Last year, they made 6.7 billion of free cash flow. They paid 5.6 billion to shareholders. 7 billion of free cash flow, 5.4 billion to shareholders. 6 billion of free cash flow, 5 billion to shareholders. You see the trend. So unlike Nike, this company has a sustainable payout. And that payout is about 80 to 90% of its free cash flow in any given year. And that's what they do. Okay, they're a cash generating machine that continues to reward investors. And investors kind of expect that. But that's the idea. They continue to generate free cash flow to allow that payout. That's a different story than what we just saw at Nike. Everybody kind of see that? Here's another company. I don't know if you can see this because the way Zoom works, but can you see this Verizon data that I just brought up?
No, I still
No.
see the Raytheon
No,
one.
with that's it, right?
I gotta
Yes.
reshare it then. Share screen. All right, here is Verizon CFI, again, simplified for the last 5 years. Okay. So these are actual here. Do a total, forgot to do a total. All right, well, anyways, here's their gross cash flow. Here's their free cash flow after reinvestment. This is their payout. In 2019, Verizon generated $22 billion worth of free cash flow, and they paid out $28 billion to shareholders, dividends, and stock buyback. In 2019 or 2020, Verizon generated $22 billion worth of free cash flow, and they paid out $28 billion to shareholders. In 2021, they generated $21 billion of free cash flow. They paid out $30 billion to shareholders. In 2022, they had $16 billion worth of free cash flows. They paid $34 billion to shareholders. In 2023, they made $15.6 billion of free cash flow. They paid $30 billion to shareholders. How'd they do that?
Debt?
How much debt over the 3-year period did they raise?
A lot.
That's $65 billion worth of new debt. Why did they borrow so much money?
For to pay their shareholders.
Which are these stock buybacks?
Hmm.
Is that sustainable?
No.
There you go. Now, if I jump over here to the ROIC tree, what do you notice from Verizon? That their ROIC went from 11% to 5% because their margins went from 23% to 17%. They're making less when they sell you a cell phone service contract. Invested capital to sales went from $1.90 to $2.41. They're spending 50 cents more per dollar to make 6 cents less every time you buy one of their products. Their business is getting more challenged. What is Verizon doing with all this cash? They're literally making less cash profit. 43 billion falling to 34 billion because their margins are going down. And they're spending more on their network. So the free cash flow is going down. Yet the payout to shareholders is consistently higher than what they make. So you tell me, why would a company do that? Greg?
Why would the company be doing that?
Yeah.
Probably because they're probably going to have to make some pretty significant changes to their business model. That's my guess.
So you're an investor How would you react to this? You're BlackRock, you work for Fidelity. They're in your portfolio. What do you think about this? Young?
I'll probably kick him out. I mean, but yeah, the dividend, they're probably increasing it to look attractive to people that are looking for income generation. But at the end of the day, it's at the cost of the company's sustainability.
And so I'm saying like, this is, and we can get into, there's some debate about that. But I would kind of agree with the comments that you're making as an outsider. But that's the point. Like, I think when you do a CFI and ROIC tree analysis, you get a pretty clear picture into what's happening with the cash flows of any business. And whether or not it looks like it's getting more attractive or less attractive over time historically. And that's the perspective of why we put things into this format. It's a cleaner form, in my opinion, of analysis than we get with traditional accounting ratios. I'm not saying they're not important, but I really think when you're trying to understand what's going on economically with firms, it's a good starting point. Right. And that's the McKinsey approach that we just did. Young? Did you have something else? Hand just raised again, or is that the same comment?
Yes, sir. I'm sorry. I didn't realize that I was muted. Yeah, I was wondering if we could go back to that tree one more time. I had a question on for Verizon.
The CFI or the
Verizon. The tree, the historical analysis tree. Yeah.
Okay. Yep.
Over there, we see the gross margin also going down considerably. Do we have any other further information regarding why that is so? Well,
I
I
mean,
guess
the
it's
operating
flat.
margin, not the gross margin. The gross
Yeah.
margin is actually staying flat. The operating margin is going down because what Verizon's been doing is their SG&A has been going up dramatically.
Okay.
So what's practically been happening is a lot of their business is the cell phone market, and you guys know what's been happening to your plans. Are you paying more for unlimited data now than you did 5 years ago on your cell phone plans?
No, not at all. Is it because it's being commoditized?
Yeah, and very competitive. All three, everybody's got a phone now. And so to get more Verizon customers, they got to take them away from T-Mobile and AT&T. Sounds like there's new customers out there that don't have phones and don't have data plans. And so that's the point. These 5G data plans, they're not raising the price where you're paying more. You're bundling and essentially getting less. So the other problem they have is, how do they win your market share? They market. There's a lot of marketing. There's a lot of giveaways of free phones. There's a lot of commercials. There's a lot of branding that's going on. There's a lot of SG&A that's being spent because they're fighting to gain market share. And AT&T looks like this, and T-Mobile looks like this. The whole industry looks like this. So Verizon is not unique. It's just they're in a different stage. Like, it's no longer a situation where there's like 3 billion cell phones in the world today? There's like, who doesn't have a cell phone, particularly in the United States? They got pretty high penetration. And so it's a hard business to grow. And it's just become a tougher business. And they're spending a lot on this, on these networks. Yeah, Joy?
So from an investment perspective, would you say that this industry is like not as attractive anymore?
So let's go back to CFI. Okay. How much do they spend in CapEx cumulatively over this 5-year period of time? Approximately. What do those numbers add up to be about?
Are those in billions?
98 billion.
Yeah, those are in billions. It's about 90-something billion dollars worth of CapEx over the last 5 years. Okay. Now, if we look at the historical 5 years, were they growing in the last 5 years? I'll go back to our tree. Were they growing in the last 5 years? That's the revenue growth rate over here. I don't see a lot of growth there. So what did I spend my 90 billion on? Well, okay, they're building the network for the future. So I put $90 billion of capital in there. I didn't really get the growth last 5 years, but I spent $90 billion. How much growth am I expecting in the next 5 years? So what I'm gonna do is I'm gonna go into Bloomberg. And I'm gonna go look and see today, what is the market expecting for Verizon's growth for the next 5 years? Share Bloomberg screen. Sharing my whole desktop actually, because it'll be easier than jumping around right now. All right, so I am in Bloomberg if you can see it. And I'll change the zoom here a little bigger. And I'm going to look at Verizon. And I'm going to look at the analyst forecast for Verizon today, which will include the next 4 years. Look at row 13 when it pops up, which is revenue. This is last year's actual in billions. These are the next year's forecast growth rates for Verizon, right? They're expected to go from 134 billion in revenue last year to 140 billion in revenue in 2027. That growth rate works out to be 1% next year or this year, 2% next year, 1% next year, 1% the year after that. That's their next 4-year growth rates. Reconcile that with the $95 billion worth of spending that they did. Is it paying off?
No.
That's their challenge.
Professor, quick question.
And by the way, do you know what the investors, real world investors, are saying to Verizon? What do you think? What do you think the investors, the BlackRocks, the Fidelities, the Vanguards, what do you think they're saying to Verizon?
Why am I investing in you when I can invest in someone else?
Well, to some degree, but what they're saying is, can you find me some more growth? Like, can you grow 2%? Can you grow 3%? Given all the money that you spent, can you find me a little bit more growth? Right? And by the way, you find more growth, you get a better ROIC, you get better margins, because all the money's already in the network. So that's the challenge. They spend all this money and they're not growing. But by the way, AT&T's in the same boat. T-Mobile's in the same boat, right? They're having the same challenges. Like if I switch this to AT&T, US equity, their growth rates at AT&T next year, 2024, 0.3%, 1.5%, 1%, less than 1%. It's the North American market. It's just saturated, right? And so that's the point. How do you grow the 1%? I got to take away from AT&T. Well, that's a fight. That's putting pressure on the financial performance of the business. So it's just, we're in a challenging world, and these companies are trying to navigate through it. But that's the challenge that they're having financially. And we see this. It's not just historical, but when you look forward, which is what we're going to do next in valuation. Yeah, go ahead, Greg.
So if you go back to Verizon, if you don't mind, there was a thing on their EBIT in year 20, their forecasted year of 27. So it looks like you were saying the growth rate is expected to go up by like 1 or 2%. But if you're looking in row 16, it's negative 10, and they don't even make that like it's like, oh, it's negative. So
Yeah.
what is any reason as to why that's so bad?
You're starting to sound like a skeptical sell-side analyst, but exactly. And oh, by the way, I'll scroll down a little. This is what they're expected to spend year by year in capital expenditures during that period of time. They're going to spend, you can see the numbers here, somewhere between 19 and 20 billion a year on CapEx. 18 billion, 18, 19 billion a year in CapEx. So spend all this money and they're not growing. So they're going to spend another $80 billion over the next 4 years, and they're not going to grow. And they might even make less than they're making today. It's just a tough business, right? So I don't say that, maybe the situation could be worse, but these are the challenges when we're thinking about valuing companies that we would see. Other thoughts, questions, comments? Make sense?
Sure, I have a question. Is that net of all the dividend that they pay out? Because when you look at Verizon or AT&T, their dividend is somewhere around 5 or 6% of the share price.
Well,
And yeah, go ahead. You were saying?
so what can they afford as a dividend? It's actually on the screen right now. What can they afford max as a dividend?
The profit.
The free cash flow.
Yep.
So they can afford to pay out the free cash flow. Okay. So how much are they actually paying in dividends?
They're paying out.
Oh, they don't actually show it in the screen, but you know, DPS stands for dividends per share. 270 per share times, get the share count. 4.2 billion shares. They're going to be paying out about 8-9 billion a year in dividends. That's what the market's expecting from them. So can they afford a $9 billion dividend a year with these free cash flow numbers? The answer is yes. They will generate enough cash flow to pay the dividend. All right. But they're not going to be able to buy back as much stock as they've been buying, not without the banks coming in. And the other part is you might actually see the market say, increase the dividend more, meaning give me more money, because rather than spending it on CapEx, because that CapEx doesn't seem to be turning into more sales and more profits. So you might be better paying out more than reinvesting more because it's such a tough market. But that's the idea. It's a tough market that they're in. So part of Verizon's challenge is finding different ways to grow. They got to find growth. And it may not be through consumer cellular. You know, that's why they're pushing business, B2B. That's why they're starting to push 5G when it comes to AI, because you can't have AI without 5G. Like all of our devices that are connecting to the cloud have to go through people like Verizon. And the problem is they're not monetizing it in a way that's helping them. They're like the dumb pipe. They've become the dumb pipe. And it's very
so Professor, I have a dumb question. For the Treasury is yielding around like 5.1 or somewhere around there for short term.
Yeah.
So compared to Treasury, and you're looking at Verizon because they're able to, you know, sustain like 1% growth after paying out the dividend, that they're still better off in terms of like the total growth.
Yep.
Than Treasury.
Yep. That doesn't sound that great, does it? So by the way, here is what the sell-siders are saying about Verizon today. Okay. These are the buy, sell, hold opinions. Okay. Of the analysts on Wall Street today that are covering Verizon and thinking about their future, 15 of them say buy, 14 hold, 3 sell. That translates to a 3.75 out of 5 on a 5-point scale. Right. And so the market is not that bullish about their long term, because, you know, you got more people who say hold and sell than say buy, because of the reasons that we're just talking about. Like you're not getting great rates of return, right? I may not get out of your stock and I like the dividend, but I'm not buying you because you're a growth company. You're growing 1%. It's not a very compelling message, other than I generate a lot of cash and I pay it out, almost like a bond. Right now, that's the thing. Verizon's almost like a bond, and their stock is not going to go up dramatically. So how did Verizon do over the last 5 years when it comes to performance? You looked at the 5-year trend there for shareholders. If you invested in Verizon stock 5 years ago today, you averaged a negative 1.44% per year loss in value. If you put your money in the S&P 500, you average 14% per year. If you bought it, the telecom index, which included other telcos besides Verizon equipment makers, you averaged 13% per year. They underperformed. That shouldn't be a surprise. Oh, by the way, what's going on with Nike today? You guys just did a Nike assignment. What's been happening to Nike share price recently? This is Nike share price over the last 12 months. This is Nike share price over the last 30 days. Why has Nike's share price plummeted? It went from 95 to 71. And almost all that drop occurred on June 27th. What happened?
A bad earnings report.
What was so bad about their earnings report?
I don't know. That was a guess.
You're right. It was a bad earnings report. What was bad about it?
I think their sales forecast are really low. They're having trouble competing with some premium brands like On and other athletic companies that are coming to market.
So this was the earnings call when they reported their May earnings results. This was the expectation, and this was the actual. They expected this revenue. The market did. They reported that revenue. Good or bad?
Bad.
They expected the reported free cash flow. But basically what happened was they had a revenue miss. And they had a margin miss. Their gross margin was expected to be 45%. They reported 44.7. So they missed on revenue and they missed on gross margin. Okay. And then you know what these red arrows represent?
The downward adjustment for the future.
Downward adjustments by the analysts for the next 4 quarters. And you know what these red arrows represent?
Just be the annual.
These are downward adjustments for the next 4 years. Nike in 2025, fiscal 25, which is based on May, will shrink. They will sell less product next year than they did last year. Is that the Nike you remember? That Nike is expected to see their revenue fall by 4% and then grow low single digits thereafter? Nike historically has been growing at 10 to 15% a year with high margins. And it came to a screeching halt. And not only did it come to a halt and they didn't have any growth last year, next year is expected to shrink. They've never shrunk. What's going on with Nike?
Their debt's caught up to them.
It's not their debt. This is the EIC part of the conversation. This is why we do EICs. I'll short circuit 2 answers. 2 things are going on here. Number one, if we did the EIC, we would notice that Nike spent a lot of money trying to get rid of the middleman and sell direct to consumer through their e-commerce site that they were building. So I'm not going to sell through Foot Locker. I'm going to sell direct to you. That was the plan. And when I sell direct to you, I capture more of that margin for me. So it's going to lead to more sales and more profits direct to consumer business. That was the big bet. And they would pull out of traditional retail. That was the plan. You know what's been happening?
Not that.
Exactly. And it's almost like the revenge of you know, what's the second Star Wars? The Empire Strikes Back. It's like the revenge of the people that you're like, well, you want to pull out of us? We're gonna sell Hokas. You know, we're gonna sell other brands. And Nike sales are gonna drop because they're not getting the direct to consumer sales they thought. That's problem number one in Nike.
Professor, on line 21 of net debt, they have negative 1455. Like, yeah, if you go to the other page you were on, their debt is like crazy.
Yeah, because they have more cash than debt. They still have a lot of cash. They have negative net debt. Negative net debt is debt minus cash. So the point is, Nike doesn't have a lot of debt. So they have a strong balance sheet. But that's not why people buy Nike. They buy Nike for their free cash flow, and the free cash flow is expected to dip. And that's their challenge. But like I said, I know I'm riffing on a lot of things, but they're similar to the type of analysis that we're doing, because this historical analysis moves into a forward analysis, which will affect valuation. So this is a setup for next week. So next week, we're going into the next section of the class, which is valuation. You're worth the sum of your future cash flows, not your historical cash flows. And the future is not always like the past. So we have to predict the future of any company. Okay. And so what you're going to do is you individually, you cannot work on homework pairs for next week's assignment. You have to do next week's assignment individually. You are going to build in Excel a reusable valuation model. And the company that you're going to do is NVIDIA. Okay. And we're going to value NVIDIA in real time based on very current data as of yesterday. Okay. Because I run another class this summer called 718F for the master's program. And yesterday we did in class, it's a 3.5 hour live class. So even though it's online, they don't actually watch videos. I have to actually teach everything in the video live. So I recorded the 3.5 hour class that I taught for them yesterday. Okay. It's on YouTube and it's now going to be on your site. Okay. Your course. And I took the videos that you were supposed to watch next week and I deleted them because they were on Nokia from a few years ago. So instead of doing Nokia from a few years ago and building a reusable valuation model, you're going to build a reusable valuation model on NVIDIA as of yesterday. And your assignment for next week is pretty straightforward. I'm going to start you with, and I'll put these files in the assignments link, a valuation model called NVIDIA Start. Okay, so it's not building it completely from scratch, but it's kind of a starting model that you're going to build to complete a valuation of NVIDIA based on their share price yesterday of $120 something per share. And so at the end of the video, we in class valued NVIDIA at their current stock price yesterday. Okay, and we built out the model that did this. Your homework assignment for next week is to replicate everything I did in Excel and build out a valuation model that matches mine exactly for NVIDIA. So by the end of the assignment, you would have built a reusable valuation model based on NVIDIA's actual data valuing NVIDIA. That is your homework assignment for next week. Okay. And what you're going to need to do is literally watch the video, follow along, and recreate that model exactly to the penny. You're going to submit that file next week. And your homework assignment is pretty simple. If you match the model, you get full credit. If you don't match the model, I'm giving you a 0. It's 0 sum. And you can't work in homework pairs. And the reason why I don't want you to work in homework pairs on this one is because if somebody gave you this fully built model, you'd have no idea why it does what it does, and it would be a black box. The only way you're going to understand how everything works is if you put it together yourself. That's why I'm going to make you do this assignment. But the nice thing is once you built this model for NVIDIA, which will take you a couple hours as you follow along in the video, using the model to value another company will take 10 minutes. And that is the model you're going to use for your group project And that is the model you're going to use next week when we look at a couple of other companies. Okay, so we can take a Nike and we can put the data in and we can see what's really going on and why it's being valued what it is. We can take a Verizon and we can put the data in and we can value Verizon, right? And what you need to tell me is for each of your companies, each of your teams, in the last day of class, you're going to have 40% of your grade is a presentation on a company. Which company do you want to present? Who do you want to analyze? I need to know because I'm going to start giving you data based on the EIC, based on the historical, and based on the valuation from Bloomberg so that you can actually replicate for your group project everything we've done in these individual assignments. And on the last day of class, you're going to do a 20-minute presentation covering all that for the company that you chose. Okay, so you have in this class, if you go to the people part of Elms, there is a subfolder called Project Teams, and there are 4 project teams. You're on those project teams. We put everybody in those teams the first day of class. So what I need to know now is what company you want to value and do your group project on. And there'll be 4 companies. They can't be the same, and they can't be a company that we've done in class. So I don't know if you've already talked about it, but if you haven't, you need to talk about it amongst yourselves and quickly determine what company you want your final group project to be on. Publicly traded, and that I'll start giving you data for. Does that make sense? Has any team actually talked about this and picked a project? So Young?
Yeah, I got a question. We picked Meta so far.
Who did
And
you- Meta?
Meta, yeah. Facebook.
Meta? Okay. All right. So
Yeah.
I'm gonna go
Um,
to, what team are you on? Group? Do you remember?
Group 1.
All right. So project team 1 is Meta. So I'm gonna start getting data from Meta and I'm gonna put it into, in the files section, I'm gonna put a folder with Meta's data in it so that you can start working on your final group project, which is basically the individual assignments, but you're gonna be doing it for your final project as a 20-minute presentation. Have any of the other groups?
I was going to ask you,
Go ahead.
I was going to ask you where to send that, the information of our pick. Do we normally email it to you?
Email's fine, but you just gave it to me, so I just changed it right now. So does anybody else pick the company?
Yeah.
Right.
Team 2 picks Chipotle.
All right, team 2 is Chipotle, so I'm gonna change that right now. And you can tell me whether they have fully recovered from their challenges they had a few years ago with E. coli. All right, team 3 or 4, did you pick somebody?
Team 4, Domino's.
Domino's Pizza. Great, we're gonna learn all about cheese on a piece of cardboard. And how profitable that business is. When I was in high school, I was a delivery driver for Domino's. All right, team 3. Who'd you choose? Who are you gonna choose?
Not yet, but we'll let you know this week, Professor.
So you haven't picked somebody yet?
Not yet.
Okay, so team 3, talk amongst yourselves, send me an email,
Sure.
hopefully in the next couple days. Right? All right, so just a reminder, I edited, and I hope I didn't screw it up, in the assignments tab. So let me go back and share again. So under home, under the week 4 assignment, I went in here and mucked around with this, which is gonna really upset the online MBA people because they don't like it when the faculty screw up their beautiful site. But where it says watch the video, it used to be Nokia, and I edited it. So if it says Nokia, I just missed it. But I changed the video to last night's class that I did in the part-time MBA. And it's about 3 hours long. It actually covers going over the assignment you just did this week at the beginning, but most 2 hours of the class is building the model for in Excel for NVIDIA. And by the end of the class, we have a evaluation as of the company stock price yesterday, and you have to basically recreate that model that we do on the video, and that's what you're submitting for next week's homework assignment.
Yeah, Professor, the video sim is just 2 hours, not 3.
The video is about 3 hours. The first hour is what we actually did in class tonight, covering the ROIC tree and CFI.
Oh, okay.
Now they actually
Just to
had
make
a
sure.
company than Nike when they did their ROIC and CFI. We in that class did Costco and Walmart. So if you want to rewatch ROIC tree and CFI for Walmart, that's the beginning of the video. That's about the first hour. But after the first hour is over, then we get to the Nike or the NVIDIA evaluation. Okay, so I'm going to put in a folder, but here in the announcements, the files that you need that we use for the video. And the most important one that you're going to need is this file, which I have to post on your site. And it's called Valuation Model NVIDIA Start. Okay, which I explained in the video, but the whole idea is I'm giving you a starting Excel file, which has the bones to be able to do evaluation. It's got the historical data. And what we're going to do is we're going to take real data from Bloomberg and we're going to create a valuation of NVIDIA as of their current stock price yesterday. It's called an as-is model. And that's what you're going to recreate starting with that file. And then you're going to submit it individually. Can't work on pairs in this assignment. And then next week, you're going to reuse that model for somebody else. And for your group project, you're going to reuse that model for the companies that you just gave me. Right. So that's your homework assignment. And so I'm just kind of telling you because I did make a real-time change in the online site. So I'm going to put these files up in just a couple minutes. All right. Hopefully that makes sense. Questions about anything?
The pathway to that file, if we go to file, I don't see week 4.
You don't.
Is it under like lecture notes?
I'm creating a folder in your site called NVIDIA, and I'm going to put all the files there. And I'm going to link it to the announcements so you can find it from the announcements tab.
Professor, there's the NVIDIA folder right now, but it's missing the start. It
I
has
gotta
the
put
other
that-
ones.
I
Okay.
need to put it there.
Okay.
I just
Thank
like
you.
right before class, I was like, I think it'd be more fun for you guys to do NVIDIA than Nokia. Just do a real company. Because I think you're probably curious, like what's going on with NVIDIA? A lot of people are. They're in the headlines every day. So let's have fun and do a current company. So that's why I made the real-time change. All right. So other than that, this class has been recorded. I'll post that as well. And I'll see you guys next week. If you have any questions about where you're doing it, let me know. Have a good night, everybody.
Thank
Thank
you.
you, Professor.
Thank you, Professor.
Yep. Right.